So on my channel, I talk about mostly investing, right? And a lot of people online tell you should be investing in your money. And I think it's the right advice. However, the question is, what type of investor are you? Which way you want to invest in? Because there's so many different ways how you can invest your money. There's not one way. Otherwise, we would all be investing that one way. And in a way, there are different, investor personalities or strategies, whatever you want to call it. And there's really a lot out there, right? Too many to count even. But in this video, I don't want to focus on 7 main investment types or personalities that are quite prevalent that I see mostly out there. And you might already be following one or a couple of different ones that I'm mentioning in this video. And if you're not, maybe that video will give you some food for thought to follow one particular direction. Again, this is not investment advice. This is just sharing what other people are doing. And ultimately, at the end of the video, I'm going to share with you my personal one that I'm currently following, because that has also evolved, because I started one way and I shifted and evolved over time as an investor to follow a different strategy. So without further ado, let's jump right in. So I made it a little bit more visual for you guys so you can see kind of what I'm saying here. The first one that I'm going to talk to you about is the dividend collector or passive income investor, however you want to call it. But I think that's really what resonates with a lot of people, because it's a really cool principle that basically you invest in stocks or companies that pay you a regular dividend. It can be monthly, quarterly, annually. And I think it's a nice feeling, right? So in addition to your share price, hopefully appreciating in value over time, and therefore your portfolio value, you also get a passive income, which comes in the form of profits that the company shares with you. And the idea here is that those really snowball over time, because most companies, they grow the dividend. So even if it pays you, let's say $1, €1 1 year, next year, it might be more than $1 if they increase the dividend, right? So the more shares you have, the more dividends you get, plus those dividends are also being grown over time, which is a really attractive way of investing for a lot of people. And you can see here how the annual dividend growth can grow over time. And in fact, that was actually one of my first investment strategies when I started off, because I was really, attracted to that idea of growing a passive income in the way, right? That one day when I'm old, I can live out those dividends. And I think it can still work for a lot of people. Now, companies, for example, would be Johnson & Johnson, Coca-Cola, Procter & Gamble. There are even some dividend ETFs. And a good example, obviously, over here on Seeking Alpha is Coca-Cola, right? It's a dividend king. They've been paying and growing the dividend for over 50 years. Unbelievable. Right now, as you can see over here, the stock has been sort of sidelining more or less for a year, 1% growth, but the dividend has been paid and grown, as you can see over here, for over 62 years, which is unbelievable. The growth rate of increasing the dividends over time is 4.2%, and currently the dividend yield is basically the dividend percentage is 2.92%. But at the same time, here you're not expecting major growth, right? Companies like Coca-Cola, they're not going to double in value over the next 2-3 years, right? It's a really slow growth company. They're just going to share some of the profits with you as investors. And that's totally fine. Ultimately, personally, I always like to look at total returns, which is a combination of, price appreciation plus dividend. So for me, I want to see the full picture, but some people really like to focus on dividend, and I think it can have its merits. A second very popular strategy is the value hunter, right? They're really looking for value gains. Now, that was probably best depicted by Warren Buffett when he was younger. He was always looking to buy undervalued companies where he sees they have more value in the future, or in his eyes right now, than they're currently priced at. And I think that could be really good strategy as well. Personally, though, I think it's getting harder and harder to find those. We have so much access to data and information, AI. So it's getting harder and harder to really find undervalued companies, but you might find them in your perspective, right? Because we might value companies differently. So here are some examples: FedEx, some other, undervalued industrial or financial stocks that you think could be a good value play. It doesn't mean they have to pay a dividend. It could be some of them do pay a dividend also. It doesn't really matter. You're really looking for companies that are currently undervalued because maybe some negative news, whatever it is, or the industry kind of took a dip, right? For example, we had smoking companies like Altria that used to be a dividend paying company that I invested in. But of course, we know smoking isn't really the future anymore. So those companies took a major hit, right? Or pharmaceutical companies, also a lot of them took a major hit. So maybe you see value in that now to capitalize on it later on if you see those companies potentially making a comeback. Then we have the growth investor. And I think that's really exciting. A lot of people like that. These are companies you invest in if you, for example, follow tech, AI, or other, future industries where you see a lot of potential. This could be companies like Google, Alphabet as it's called as a stock ticker, with Amazon, Microsoft, Apple, those companies that are already established, companies with big valuations, right? Some of them are the most valuable companies in the world. So obviously the growth already has been priced in there, but still they have potentially quite high upside potential, right? A company like Amazon, even though it's already so highly valued, probably you would expect higher growth for a company like that than, again, Coca-Cola, right? So that's just, the growth investors mindset. And most of those companies usually also don't pay a dividend. Some of them have started, but it's really tiny. I mean, we're talking about less than 1% for sure, which is going to be very hard if you wanted to live off that, right? So you wouldn't invest in those companies if you wanted dividends, but here you really invest for growth, stock price appreciation over time. I think it could have its merit. Now, of course, at the same time, while they could potentially outperform the market, keep in mind that with high growth comes also higher volatility. Same as we see, for example, with Bitcoin, right? It grew tremendously, but also it dropped tremendously. You have some major swings there, more volatility as we call it. So that could be expected also with growth stocks. With this, we move up one more level to even higher risk. The high risk, high return investors, I call them. They're really not too worried about losing their money, but they want the highest possible return. And they invest in companies like Robinhood, Palantir, or Tesla, right? Those companies where you would maybe say fundamentally, the valuations they're having these days are absolutely mind-boggling. I mean, look at a company, for example, like Palantir, right now has a PE ratio of 273. I mean, just absolutely beyond any imagination. And still, for some people, it's still underpriced, right? So the way you could even say it's a value play where they say it's still undervalued in their opinion versus what they might be worth in 10, 20 years from now, right? So again, everyone has to do their own analysis. If I compare that valuation to Google, for example, Google right now is at a PE ratio of 20. So less than 1/10 of the one of Palantir. So just, gives you a perspective of how they're very much differently priced. So here you're really swinging for the fences. It's often all in or nothing, right? So either a company might completely collapse on drop, even go to zero potentially, or if it does exceptionally well, it could give you, a 20, 30, 40x return, which would be incredible, right? But the chances are that you get this right every single time, very tough, because if it was so easy, a lot of people would be doing that, but you often burn your fingers. So here, maybe you want to have a smaller part of your portfolio allocated to those. Obviously, as I said at the beginning of the video, there's not just one single type of investing. You might have some dividends as your base, maybe some ETFs, we'll come to this in a second, on top of it. And then at the very top, a small part of your portfolio, maybe 5, maybe up to 10%, depending on how risky you feel, you might want to allocate to some of those companies where if they were to go to zero, well, it would be painful, but it wouldn't really destroy your portfolio. But if they were to, 20 or 30x, that could really boost up your overall returns of your portfolio as well. With this, we come to the ETF believer or investor, however you want to call it, but basically people who say, well, if I can't beat the market, I might as well join it. And honestly, for most investors out there, myself included actually, probably the smartest way to invest. Now, having said that, it doesn't mean that you choose any ETF and you're going to get market returns. An ETF is just a vehicle, right? You could have a very risky ETF. Some ETFs, they follow, extremely risky companies, right? So you're equally exposed to that risk. The only difference is that you don't have to actively manage it. It will be done on your behalf by the ETF provider. But if you were to go with a really diversified ETF, like an all-world ETF that invests in companies that are stock listed around the world in many different countries, many different continents, different industries, or for example, what I like is the S&P 500, the 500 biggest companies in the US, well, you're going to be diversified. It's going to be totally passive. And even if today the most valuable company is, let's say, NVIDIA, well, if 5 years from now, it's not anymore NVIDIA, but another company, it really doesn't matter for you because you're still going to be investing and benefiting from those growth companies, whoever is at the top at the time, because you're investing in the overall index, right? So your money is invested in the index following those companies, however they're composed of. But since you can't directly invest in an index, you need an ETF provider like Vanguard, BlackRock, many out there. I personally use State Street for my S&P 500 ETF, which is this one over here. You can see I'm currently paying 0.03% fee for the ETF provider, which is State Street. And well, the rest is done on my behalf. They rebalance automatically. The dividends are paid to me on a quarterly basis because yes, I still earn a dividend, even though it's very small. As you can see over here, it's around 1.07%. So again, it's going to be hard to live out the dividend, but it's a nice touch to have. I get it paid to me quarterly into my various brokerages that I use, and it's nice. And this is really very passive way of investing. Ideally, you want to automate it, right? So you don't have to think about going into your broker weekly or monthly to place an order. Just set it up once, set and forget it, and it will all be done for you. So that's probably the most hands-off, easiest way to invest if you choose a good ETF. And I think it can really make sense for a lot of people. Next up, we have the traders, right? And that's usually what I see on Instagram or YouTube, all these traders, day traders. Oh, how much money I made today. And they make it seem so effortlessly. However, at the same time, very often, they actually make their money selling you the courses or the information rather than the successful trading strategy. Because otherwise, guess what? They wouldn't have to sell you those courses. They would just make the money themselves, right? But anyway, that's a topic for another video. But basically, here you really want to enter and exit the position very quickly. All the other ones we spoke about are usually more long-term oriented, right? Maybe the high risk could be a bit more short-term, but generally, dividend investing, growth investing, you talk about investing for a number of years at least, right? Short-term trading, as the name implies, you're really moving in and out of positions up to maybe 2 weeks, right? Which we call swing trading. So even in short-term trading, there's arbitrage, there's day trading, there are different terms for that. But let's say, anywhere from a couple of hours to up to, 2-3 weeks, I would say. And here you're really moving in and out. You're trading news, you're trading momentum. So these are the guys looking at the charts and thinking they can outsmart the market, even though, again, personally, I might be biased, but I really don't think you can do that successfully long term. And if you do, you would be a very, very small percentage. Will you have some good, profitable trades? Sure. But often those traders won't show you their negative and not successful trades. And that's when you really average it out. Often, they don't really, turn out too well. But again, maybe that's what appeals to you. You can give it a go. I tried it myself as well. I burned my fingers. So that's why I know to stay away from it. But maybe you like it. Again, I'm not, judging anything here. I'm just giving you different options and different investment strategies. And for short-term trades, often we talk about companies like Nvidia, Tesla, or even smaller companies, right? We see sometimes on Reddit, where people, hype up a stock, they move in and out. It's kind of meme trading almost. That's short-term trading. You're really trading on news, on sentiment. So that's what I mean by that. And lastly, we talk about contrarian trading. So that's really taking the opposite opinion of most people, right? When most people say a particular stock or company is going up or is in a good position, those people say, no, it's the opposite, it's overvalued. They might take even a short position, meaning betting against the company. So instead of increasing prices, they bet on falling prices and they make money when they do fall. This is what we call shorting a stock. Or if a stock or company, we've seen this obviously, back in 2020 in the pandemic, when airline industry was, for example, majorly hit, right? Or hotel industry was majorly hit, the prices dropped massively and most people were scared of it. They sold out, the prices dropped, and then the contrarians would actually come in and say, no, now it's a great time to buy because I actually see that going up right after the pandemic and they will outgrow all the other stocks and they would open a position back then. So they kind of take the opposite approach to most people. And again, it can work out, right? But often it also doesn't. So again, it's a bit more tricky and risky investment style and strategy. But if you do make the right bold bet, it can also really play out in your favor. But again, it's obviously a little bit trickier to assume and anticipate. And I think with the influx of more information, AI and so forth, I think it's going to get harder and harder to really have a serious contrarian position because AI already gives us so many different perspectives on different stocks and investment strategies that I think it's really going to be very difficult to have completely a contrarian vision on a stock, market, or industry. But if you do and it works out, well, it could be a great investment strategy. And again, maybe part of your portfolio, not all of it. I wouldn't invest 100% of my portfolio in a contrarian call. Maybe in some, I might take a bolder position to kind of just go against the stream a little bit. But overall, it doesn't really resonate with me. And that also brings me to the point that your investment style might actually change over time. When you start in your career, you have very little money to invest. You might be leaning more towards growth investing, right? Because it's more exciting and your potential growth in your portfolio might be much higher, right? If you have €1,000 to invest, worst case it goes to zero. It's painful. But it's not your whole life savings in there, right? Versus if those €1,000, 10x, you might have 10,000. So that's a major change for you. So, a dividend investor with €1,000, you earn maybe 5%, 5% on €1,000, that's €50 dividend income for the year. Pretty boring for most people, right? You don't get excited about it. So I really understand how that changes over time. You might move later on into more ETF because you have a busy life, you have a family, you're fully dedicated towards your job or your business. So you don't want to be so hands-on. That's why you shift from growth to ETF investing. And then maybe later on, when you're retired, you move a bigger part of your portfolio into dividend stocks to collect that passive income, which could be a great idea. Now, personally, I've also changed my strategy a number of times, I would say. I started off initially buying just about anything I read about online where people said, that stock is great, buy it. I did buy. And well, some of them did actually quite well. Others didn't, so I kind of learned my lesson. Then I started getting really excited into dividend investing, built up quite a sizable portfolio, got some nice passive income in a year, over 1,000 euros in dividend income, which was great at the time. But at some stage, I realized that I'm really looking after total returns, not just dividend returns. And I noticed that a lot of my dividend-paying companies actually underperformed even the market, meaning the S&P 500. So if it returns the market 8%, I would get my total return with dividends and stock appreciation to maybe only 6 or 7%. So I'm technically not maximizing my money. And I'm too early to want to live off dividends, right? And then I moved to ETF investing. I put all my money in the S&P 500 for a while. I actually did pretty well. And I'm a big believer of that. I still have majority of my money, apart from my crypto, in S&P 500. And I really believe in that, or other ETFs. I also have the NASDAQ 100 ETF. Now I kind of moved to my most recent investment approach, I would say, which is sort of a hybrid, right? So here I have majority of my money in ETFs, but on top of it, I layered, let's say, growth companies, but more conservative growth companies. Because right now it's basically two. I have Amazon and Google in there. I might eventually add also Microsoft. In a way, they're kind of boring and predictable growth companies, right? I don't see them doubling in value for the next 2-3 years, but I could definitely see them outperform the S&P 500. So potentially higher risk, but also higher upside, right? So that's why I'm happy to put them on top of it, but still a smaller percentage than my S&P core holding. And that's why I also say you can kind of mix and match a couple of those. You don't just have to follow one approach. As I said, maybe your base would be an ETF investing portfolio with a bit of dividend income, and then you play around with a small percentage of your money and put into either growth or high growth companies, and that keeps you excited to still kind of follow the market. Or you say, you know what? I can't be bothered reading the news and follow my portfolio, seeing those swings up and down on a daily basis. I just want to set it and forget it. Invest into ETFs, maybe an all-world ETF or S&P 500 ETF. Great options out there. Just set and forget it. Have it auto-invest on your behalf. And that's perfectly fine. So as I always say, there's no right or wrong way to invest. Well, maybe there are some wrong ways to invest, but there are also many right ways to invest. But it has to really work for you. Understand who you are as an investor, your risk versus reward profile. Some people, they're fine with some risk. Others absolutely hate risk and they don't want to see any real swings or major volatility. Figure out who you are, maybe try different strategies with small amount, play around which one works for you. I think also over time, you naturally evolve and go into different strategies. That's perfectly fine. But I'm interested to hear from you. Let me know in the comments down below what kind of strategy most resonates with you. Hope you enjoyed the video. If you did, give it a like, subscribe to the channel, helps out a lot. Next up, check out this video over here. As always, thanks for watching. Stay healthy, get wealthy. See you in the next one. Ciao.